This video, I want to talk about the advantages of impact first investing. Impact first investing focuses on generating positive, social or environmental outcome alongside financial returns. So here are the main advantages of this approach. Number one is direct positive impact. You seek to create direct positive impact on the environment, on the community, or in the society. The primary advantage of impact first investing is the ability to contribute directly, to social or environmental change. Investments targets pressing global issues like poverty. They consider climate change, education, healthcare, and creating measurable positive effects. So that is the very aim, the core objective of this impact first investing. Number two is alignment with values. Alignment with values. You discover that impact first investing allows investors to align their portfolio with their portfolios with their personal or organizational values. Not only that, this can be fulfilling for individuals and institutions looking to make meaningful difference through their capital. They have sufficient capital and they want to effect social change, environmental change, and at the same time make profits. So it's like a win-win situation. And number three is access to high impact opportunities. Access to high impact opportunities. Impact first investors often fund underserved sectors or communities, where traditional investors may not want to invest. Supporting innovation in areas with high potential for positive change, areas where a typical, normal traditional investor will not want to dabble into. So, impact first investors are ready to go into those core areas because essentially they are looking for impact first. Then the profit can come in later, unlike traditional investors that are looking for profit and returns alone. Number three is access to high impact opportunities. Access to high impact opportunities. Impact first investors often, I think we should be talking about number four now. I'm through with number three. Number four is number four is catalytic effects. Catalytic effects. So impact first investments often attract additional capital by proving that a social impact venture can be viable, helping scale solutions and then creating momentum for broader market adoption of impactful practices. By the time they go in, and people can, other investors can see the impact, they can equally, observe the profit coming in. It might serve as a catalyst for would be finance and impact first investors to come in into such ventures and, lend in their capital. Number five is enhanced portfolio diversification. Enhanced portfolio diversification. And so by investing in unique sectors, or impact-driven companies, investors add a layer of diversification that may offer different risk return characterized, risk return features or characteristics than traditional assets, and so they are kind of fully diversified. Even when they are involved, in impact investing, they diversified across different sectors that provides, you know, environmental and social impacts. So they're adequately diversified. Number six is long-term societal and environmental benefit, long-term societal as well as environmental benefit. Investments that promote uh, social changes such as sustainable energy or access to education often have a long time a long-term social benefit. It takes time actually, and it occurs, it accumulates over time. So this long-term perspective can create value that outlives the financial return. It's not all about financial returns. Typically, you'll be happy when you see your investments, producing admirable, satisfying impacts in the community or in the environment. It brings that feeling of joy and fulfillment. You know. Number seven is support for innovation. Impact first investing encourages the development of new socially driven businesses or business models and products that might not attract traditional funding. This support can lead to innovations that address critical global challenges. In a case where the nature of the business, the nature of the venture or the enterprise cannot attract traditional funding, let's say from the stock market, so in this case, impact first investors will come in and lend their support. So it attracts funding that may not be obtained through traditional means like the capital markets, and by so doing, they equally attract support for innovation. Number eight is strengthen brand reputation. So for institutional investors, having an impact first portfolio can enhance reputation and align with corporate social responsibility goals. So by the time a company is involved, in this kind of strategy, you discover that the goodwill, the reputation will kind of, it will skyrocket. It attract kind of goodwill. So it will strengthen the brand actually. Number nine is loyalty and resilience. Loyalty and resilience. Impact first businesses often benefit from loyal customers, from their loyal customer bases, and this can equally bring in community support, which can improve long-term resilience and stability in challenging market conditions. There's this let's take for instance a shop that sells organic food. Discover that they have that patronage that is quite encouraging, and they can be in business for a long time. It promotes loyalty. Their customers are most of the times loyal to them. So that will help to sustain their businesses, on the long term. Number 10 is potential for concessionary returns with positive impacts. Potential for concessionary returns with positive impacts. While financial returns may be below market rate, is always lower than what is obtainable in the stock markets. Impact first investors can still realize modest returns, offering a balance between impact and capital preservation. You may not lose your capital, but you can still be getting, kind of marginal returns compared to other asset classes or other investment vehicles. And so impact first investing is an attractive approach for investors looking to leverage their capital for greater good. So although financial returns may be secondary, actually, the potential for social or environmental change often outweighs the monetary trade-off for the investor. That is it. The joy of creating an impact in the community and the society will act as a motivating factor, even when the returns coming in is relatively low. That is it.